What I worry about is it looks like the dual mandate, one side of it is totally under control. So it gives you freedom to go after inflation because the job market has stayed so strong. So I would say, so you would say that the risk is that inflation is not conquered at this point. But I think you need always in the back of your mind to realize that if we don't need to cause a recession, there's no reason to be responsible for one and stay too long, stay tight for too long. Don't forget, even though it seems like the unemployment is not, you're not worried about it, you could be worried about it very quickly and you could stay too long and you don't have a crystal ball. And you know, just like you didn't know inflation was going to be stayed at zero, that's the criticism for too long, you could stay tight longer than you need to. And suddenly the soft landing is a fantasy that didn't happen. So
these are the exact debates that we are all having with each other. I can speak for my colleagues. We all want to avoid a hard landing. 100% of us want to bring inflation back down to 2%, and we want to preserve a strong job market. And we're all very happy with the progress that we have made and how robust the job market has been. But we also know we need to complete the job. And so we have to go all the way there. And hopefully we've done enough, but we just don't know right now.
Neel, there's been a measurable change in the tone and the reality, I think, of what's been happening with higher rates and their impact on the economy. Every day, it seems like in the Wall Street Journal, in the lead position is some impact of higher rates on the real economy. Story today about rollover of debt. Yesterday about how it's beginning to bite and hit people. And I want to really pick up on Joe's question. Are you satisfied? Was it the intention of the Federal Reserve last week to give a much more hawkish message that resulted in additional tightening of financial conditions in terms of higher long-term yields? Is that what you guys want right now, or are you beginning to be, do you have any concern at all that you have gone too far, that steak is going from medium rare to well done?
Yeah. Well, I don't think that it was anybody was making a decision to say, I want to try to tighten financial conditions using the summary of economic projections. That is a collection of 19 individual forecasts, for lack of a better word, or projections of optimal policy. And you look at the data, look at this. In June, the SEP had around a 1% real GDP for 2023. In September, the median was now 2.1. That is a monster revision in 3 months. The economy has been much stronger than any of us appreciated. One would think that policy is going to respond to that.
But I could argue back with you, Neel, that the essential mistake you made in that forecast there was that GDP doubled and inflation came down more than you expected. So you got the result you wanted without having to bring GDP down to 1%. Why not let it ride? Instead, you're trying to quash the economy and create a recession.
Well, we're certainly not trying to quash the economy or create a recession. Some of that progress has been energy prices, which, as we discussed, are volatile. Core has been stickier. Services has been quite sticky. And the fact that by some measures, housing is ticking up again. I know you mentioned, Becky, that it's supply. No question. But there's also demand matching that supply. Gives me reason to be paused.
I mean, there's a lot of pent-up demand.
There's a lot of pent-up demand.
And rents are going up. And by the way, everything you do to try and fix inflation makes housing more expensive, which makes rents go higher because you can charge more for rent when people can't afford to buy. It's a crazy cyclical thing that just catches people who happen to be in a position to have to move right now.
Yeah. We nonetheless have a job to do to get inflation back down to our target. And if we simply said, well, there are all these factors and let's just call it good, then all of a sudden we said 2% and now it's 3%. And that absolutely undermines the credibility of the Federal Reserve.
So you have to take a much higher level perspective on all of these things. There's going to be problems that pop up all over the place that you don't love, but you have to live with to keep your eye on the bigger ball, which is making sure inflation doesn't get out of control. We had an investor here earlier this morning, Mel Lagomasino, and she cited what you have been saying, what you wrote, as a reason that she thinks a recession is coming. She's like, listen to what Kashkari says. She's really worried that a recession is coming because of what you've been saying. Is that the intended effect that you have, that you wanted to have by saying these things, that you think we're going to have to keep rates higher for longer?
Well, it's a funny thing. If we have to keep rates higher for longer, it's because the economic fundamentals are even stronger than I appreciate, and the flywheel is spinning. It isn't obvious to me that that means that a recession is more likely. It just might mean that we need a higher rate path to get inflation back down to 2%. Again,
why couldn't it be normalizing from the rates where they should be finally, I've heard people say that. You go back to the great financial crisis. What were yields the years before that, leading up to the financial crisis? About where they are now. So maybe we're here. Maybe the next move is, a little higher, maybe a little lower, but we're here permanently. And we've lived with rates. And you're never cutting. What if you don't cut in the next 5 years? Is that possible?
If the neutral rate has gone up, because what determines the neutral rate? It's the balance between the supply and demand of investment capital. Demand, investors and savers meeting, that sets the neutral rate. So if there's big demand for investment capital in America, that's a good thing.
Good, and it should cost money to get capital.
It costs money for high NPV projects. So if that was one of, hey, there's strong economic growth and a lot of investment, and that causes the neutral rate to go higher, that's a good reason.
So, Neel, what's your best guess at where the funds rate is this time next year?
And who are the biggest hawks and biggest doves? Who do you argue with the most?
Well, I'll tell you this. My seatmate, for a variety of reasons, I have assigned seats next to Austin Goolsbee.
You do?
Yeah, so Austin and I have become good buddies.
Is it alphabetical, or is it based on
I'm not sure.
geography?
When I got here, I've got the St. Louis Fed, Sir Jim Bullard next to me.
It could be. I could be.
Have you been arguing with Austin lately? More than normal? Have you called him an ignorant? No. Okay.
Austin's a good guy.
So tell us where you think the funds rate will be.
I had in my SCP projection the funds rate basically holding flat next year.
Flat.
Basically saying go up one more tick.
Doesn't that mean if inflation comes down that you're going to be tighter and more restrictive next year?
Yes, it does.
Why?
If in that scenario, we will all look at that, and if it makes sense to dial back a little bit to keep the restrictiveness constant, we can do that. But you're having to write something down. You're having to pencil in a forecast with a lot of economic uncertainty. You can't play out every different scenario and say this is exactly how it's going to play. You got to write something down.
How shocked would you be if you guys orchestrate a perfect soft landing, like Nadia Comaneci or something? Would you? Is it? I mean, you just say it's too good to be true. Do you think it's too good to be true?
I would have said it's too good to be true a year from now. Over the last 9 months to a year, things have really moved in our direction, which I'm feeling better about. But
you know what? That would be non-consensus because no one believes you can do it. So maybe you will.